once a week, as long as we're where we are, and hopefully in the future I'll keep doing them, is the idea behind them is for three things: to kind of give you an idea of what's currently going on in the market, how we can look at the past, what went on in the market, and use that for what's going to happen next, and then what I see is happening next based off of how everything is shifting. Stuff's happening daily now and weekly, so I'm just trying to keep you guys in the loop on what's going on now, what I think is going to happen in the future, and then what historical facts can we base that on to make a decision on what we should be working on next. So, with this presentation is what's next in real estate. So we're going to get to it. So we're going to start with the history of the real estate recession and what will work next. Now, I know it sounds like a lot, but it's not. But I just want to, what this is supposed to do is speak about the other recessions that we've been through, because we are in a recession, even though it's kind of an awkward one. We are in a recession. So speak about what's happened in the recession, in past recessions, to see if we can take notes from that on what's going to happen next. So recession doesn't mean housing recession. That's first of all, most importantly. In the last 5 recessions, only 2 of them have produced a down real estate market. And in 1991 and 2008, both of those recessions were caused by a housing crisis. So those were actually housing crisis recessions. In 1980, 1981, and 2001, the real estate market was actually up over 5%, which is important to kind of reassure people that you're going to be speaking to, that just because it's a down market doesn't mean it's going to be a down real estate market. I believe this will be more like 2001 than 2008. In 2001, which was the tech bubble, most investors' biggest losses came in the stock market because of the internet bubble, not in real estate. Real estate was actually up in 2001, 6%. So I think we can look to some of the history of this to see that this may not be a down market as far as real estate goes. And I think it's important for people to understand that. 2, historically, rental properties have performed well during recession. Average rents in the top 50 markets have risen 22.3% since 2008, since the last recession. To put this in context, a typical household spent just 29.7% of their income on rent in 2006 before the crash. Since the economic crisis, that number has increased an average of 34%. So why I believe that is important is because you're going to have a lot of investors who are getting out of the market, a lot of investors are thinking about getting in the market. It's important to show them that there's still a big rental market out there for them to buy multifamilies or investment properties, whether it be single family or multifamily investment properties, that there's still really a strong market for that, and rents have actually been up, and I think they'll continue to rise. Something that's going to complicate that number a little bit, I'll get to later, as far as what the vacancy rate is going to be over the next few months. But overall, you're going to, rent has increased since the last time we went through this. 3, stock market uncertainty and volatility have historically pushed investors into real estate, where there's less variables and more of a secure long-term investment. I believe you will see investors who have left real estate because of compressed margins over the last few years come back and replace inexperienced investors who will over-leverage and not as seasoned. We're going to speak about this later in the presentation, but what I'm seeing, because investor financing is drying up, a lot of the new investors or the people who've come into the market in the last 5 years, you're going to see leave or not have enough capital to keep going, because they were really buying most of their properties on leverage, and they were financing everything with aggressive financing. What I think you're going to see is a lot of the investors who made their money, and big money, between 2010 and 2014, 2015, and have left investing since then because the margins weren't big enough, they're going to see them come back in. So it's important to note that you should be on the lookout for new investors and seasoned investors, which will be better for you in the long run, because more of the money they're going to be putting into the market is going to be their own capital, and not capital they have to get that's financed. And it'll be easier transactions to you. So I think it's something that we should be aware of that's coming, and you should be on the lookout for. Guys, if you have questions along the way, just put them in the chat, and we're going to answer everything at the end. Real estate investment trends post-recession. So where will there be value once business bounces back? So this is kind of where I think we're going to be at the end of this, and where we will see value at the end. This is important, kind of just for what you should be concentrating on more than anything else. Where the market is going, and where your focus should be. Actually, guys, I'm sorry, I got to go back one because I missed the page. These are the facts of what 2020 will look like for real estate. So this is what I think that we know already. Some things we don't know, some things are completely undetermined, but these are things that we know is going to be for the rest of the year, I believe, as far as today goes, this is what we're going to know. One, interest rates will remain low as the Fed continues to buy mortgage-backed securities in the U.S. and from under pressure foreign countries who want significant amounts. This will keep rates low for the foreseeable future. You're not going to see a significant increase in interest rates until I think at least after the election or until the election or until we find some stability. So buyers will still have more buying power now than they will have in the future because the interest rates are going to stay low. Two, investors have lost aggressive financing options, and this will cause some under pressure sales over the rest of the year. When properties are financed, not selling as fast, and currently in danger of not collecting rents, you will see some financially strapped sellers. This historically has shown more inventory coming to the market at discount prices. So the crisis we went through last time was a subprime crisis, and that really affected mostly owner-occupied properties. What you're going to see now is a market that disappeared that's going to affect investment properties. So I think where you will see a bigger recession and some deterioration in the market is investment properties. A lot of people who did fix and flips are going to have trouble finishing their projects because the financing dried up. What's going to happen with that is they're going to have to unload inventory or take a more reasonable price in inventory to keep it going. This is where you're going to see discounted properties on the market. Now, what used to be a market that was mostly multifamilies for investors is now a market that really includes a lot of single-family rentals. So as realtors or real estate professionals, what we should be looking for, whether we're looking to invest or advise our clients, is there's going to be properties on the market that are either unfinished or just finished that are going to be sold at discount prices. And I think in the next 60 to 90 days, you're going to see a lot of that. It's going to start to see a lot of that through the end of the year. So it's something you should be aware of and on the lookout for. Three, China is our only example as far as the housing market dealing with this crisis. Over the last quarter, housing sales have decreased between 30 and 50% depending on the market in that country, mostly because of quarantine. I can only expect the next quarter to look the same here. Look, the housing sales numbers came out for February this week, and they were good, obviously. March and April are going to look completely different. March maybe not be as affected as April will be, but you're going to see some numbers that be affected. What you have to do is keep people informed so it doesn't scare them off the market. People aren't buying houses because they can't, not because they didn't want to. In 2008, people stopped buying houses because they couldn't, because there was no financing, and because they were scared of the market. This isn't the same, so I think just because housing dips, we just have to inform people that there's a reason behind it, which they should know, but it's important to keep people informed on that, and it's important for us to pay attention to what's going on in other markets that are ahead of us. Like China, for instance, is going to be 2 to 3 months ahead of us in general. So that's going to tell us, it's not the same economy, obviously, but it's going to tell us some of what we want to see. 4, this crisis will inevitably change behaviors. More people will work and shop from home, which could be positive for real estate. It could mean less commuting and more of an emphasis on homes that provide a comfortable option to work from home. It's a trend to stay ahead of now. I think this is really, really important. I think inevitably, less companies will require employees to be in the office. Less people will want to go into the office. More people will want to work from home. Whereas commuter towns have always been the focus of a higher price point, a more desirable area. I don't think that's necessarily going to be the case on a go forward. Not completely changing, but it could change. Whereas people may be looking for more space rather than commuter towns. So again, it's markets you may want to start looking to focus on, because you could be ahead of the curve in looking into these markets that are going to be hot markets that weren't before. Okay, so now real estate investment trends post-recession. Where will there be value once business bounces back? So I just want to focus on what our 2 main customers are in this next part, which are first-time home buyers or home buyers and investors. Those are really going to be our 2 major clients when this is finished. First-time home buyers have the same needs and qualifications. The peak of home ownership before 2000 crash was at a 69% rate of home ownership and fell to 63% after. Home ownership for the last quarter of 2019 was 65%. So as you can see, we're closer to the average than we are in an inflated market. We weren't in an inflated market as far as home ownership goes. A big part of the pre-market crash was subprime lending, which had looser lending criteria. So when that went away, a huge portion of home buyers did not qualify anymore. From 2008 to current day, over 90% of loans are funded through Fannie Mae, Freddie Mac, and FHA. Those guidelines, for the most part, have gone unchanged, meaning all the loans they qualified before this, they will still qualify for. So, just let's talk about that part first. the majority of the financing that was available, besides investor financing, is still going to be available 2 months or 3 months from now. It's not going anywhere. As a matter of fact, they've done something to expand that financing. We'll get to that later. So as far as that goes, we're in really, really good shape. Investor financing has kind of dried up, but as far as that goes, we're in good shape. So, that's a positive. What I think we may have to watch out for is issues with gaps in employment because of work stoppages. A lot of people are either on furlough or have been laid off. It will be more important than before to have all your buyers pre-approved, before, whether they're buying a listing or a listing agent on the deal, because we don't know what that's going to mean as far as them qualifying with them being out of work. So if they're ready to buy, immediately have them speak to a lender first, because you don't want to waste your time. I also do believe at some point lending institutions will have to make specific guideline exceptions to unemployment because so many people are out of work. So I think that what they haven't done yet, they may do in the future, whereas they may have to adjust the guidelines for unemployment because so many people are going to be unemployed. We may see unemployment hit 2 to 3 million in the next couple of months. So I think that there's going to have to be some adjustment in the guidelines, but we haven't heard about it yet. But it's something to kind of be aware of as far as first-time home buyers go. Investors will need to concentrate on rentals with more certainties and less financing available. The average rate of return on a residential rental property was 10.6% in 2019. That number will take a hit in 2020 because of increase in vacancy rates due to missed rental payments during crisis. So guys, more importantly than anything at this point now, is that rate, people are going to look, what's the return on my investment for investment properties now? And that number is going to take a huge hit because a big factor in that number is either vacancy rates or missed payments on rent, which is going to be a lot of right now. So the cost is going up, the income is coming down, so it's something to watch. But again, you have to be informed to be able to tell people, like, look, you can't look at that rate specifically because this year is different from anything that's ever happened in the past. So that rate's not going to be accurate for 2020. It's important that we know that. What we will need to do is educate our landlords on the long-term benefits and show them rental income that comes with certainties. I believe Section 8 rentals is a strategy that will be more popular because of certainty of payment. Again, I don't think everybody should be doing Section 8 rentals, but I think it's something you should look at this point because it's guaranteed money. And I guarantee those landlords right now are doing well. So whether you're looking at those landlords to buy more properties or looking at stuff that actually is affordable housing pricing, it may be something that helps your business. Here are some of the issues we will be facing. Financing outside of agency, Fannie Mae and Freddie Mac has completely come to a halt, which means they are going to have to prove income again and personally guarantee the loans. These are investors. The loans most investors were taking over the last couple of years were not requiring them to show income, and they were able to close under an LLC. These loans did not take into account their personal debt or personal tax returns, so they were much easier to qualify for. The bad news is less will qualify. The good news is you're going to see a higher quality investor, and with the sudden shift in the sector of real estate, we will see more inventory available for those experienced investors and home buyers in general. Look, as whether mortgage company or real estate agents, what's most important for us is that there's activity in the market. It doesn't matter who there's activity with as long as there's activity. So yes, we're going to lose some investors for sure, 100%. But we're going to gain some investors back. So again, it's a matter of who you're reaching out to, how you're letting them know you're an expert on the market, and how you're educating them that's going to help you when the shift happens. Because a lot of these investors that qualified before are not going to qualify anymore. And it's important that those investors understand that we're educating them on, look, this is what you need to qualify now. And we're going to cover that at some point as well. I believe single multifamily rentals will continue to have a great value as they did post-crash of 2008. During the crash and after the crash, they had great value, those rentals. But second home vacation rentals and Airbnb are going to take a temporary hit. Airbnb specifically, I think that you're going to see changed behaviors after this is finished. You're going to see less travel. Until you see airlines come back and travel come back, Airbnb is not a good investment strategy right now. And I think people need to understand that if you're buying something to Airbnb it and not for a long-term rental, that this isn't the time to be doing it. So it's something I think you need to make clear to the people you're advising. So we're going to do a quick social media tip, and then we're going to get back to the mortgage stuff just to kind of break this up a little bit. So this is the social media tip I came up for this week. How can I adjust to this new world of branding? We are all home, so that is the new norm, and we'll create a new reality when it is over. I believe that this extended stay at home will forever change our daily lives. We will now do much more video conferencing, ordering online instead of going to a supermarket, and working more efficiently from where we live. So what does that mean for social media? You have to have an effective way to market yourself from the seat at home and now and on a go forward. So right now a lot of us are posting old stuff or posting this or posting that. I think you have to find a strategy over the next 2 months to be able to post right from where you're sitting. So this goes back into kind of what I said last week for those who were on last week. I think reading is very, very important. Look at the news, look for stories that affect your market or the real estate market in general, and put your own spin on that and report back on that. Focus on posts that are informational about topics that can drive interested parties to you. It could be something like how to search, find and walk through your dream home from your living room. Set up a video call with me today so I can show you how. Guys, look, Zoom is really, really cheap per month. It's like $10 a month for you guys to have a Zoom account. It's worth it for it to be invested in this point right now so you can have video conferences with people. Or I'm educating buyers today on where to look for value in ABC neighborhood. Sign up my Zoom link in my bio. Whether we like it or not, more people will want to consume information and meet virtually, so we need to adjust our brands. So again, there's a million things you can do from where you are. You can still, it's important that you don't stop your momentum. You can't show houses now necessarily. You can't have open houses, but you still can be the source of information. People can still trust you to tell them what's going on in the market. So I think it's important that you still continue to do this and you find a new way to post on social media. So this is just a tip I have for the weekend. If you guys have questions about this, let me know, whether on this chat or afterwards, just let me know. What do current finance options look like? This is our weekly update. So this is something we went over last week, and we're going to add some stuff to it and kind of go over last week what we went over that's still relevant. So guys, this is a little bit more info than a lot of you need, but I'm going to give you the info because it's good for you to be informed, and more for it's good for you to be informed because it's good for you to know who you're working with. And this isn't a Cardinal financial plug or anything else, but it's good for you to know who you're working with at this time, because changing banking policies can change how your customers are being treated, or the buyers or the sellers are being treated. That's going to affect your commission. It's going to affect their housing situation. So you need to be informed. So why some mortgage banks could be in trouble, and how could this affect real estate? Most mortgage banks hedge. This basically means that they're taking locks in the market. Again, every bank takes interest rate locks, right? We lock loans at the time they come in or whenever we lock them. We then hedge that locks against the market. So we try to off our risk. So we take a guarantee of that interest rate in the market. So it's like a locked-in buying position for us. So either the lock loan is going to make money or the hedge position is going to make money. We make sure that we're insured money on that lock, right? So it's either going to make money one way or the other, but we're insured. When the market is so volatile like it is now, the market that is taking the hedge position, so the marketplace, hey guys, I'm sorry, we lost connection. So hang tight. Sorry about that. All right, does everybody see me again? Chris, am I good? All right, cool. Sorry about that, guys. So basically, back to with the hedge. So basically, when the market is so volatile, the more loans that are locked, the larger the hedge we have to take. So what's basically happened is just like when you buy stock on margin, it's like us buying mortgage locks on margin. Everybody's getting margin calls, like millions and millions of dollars of margin calls. So what's going to happen is a lot of these banks don't have the cash available to meet those margin calls. And what's happening is a lot of them are either changing their lock policies or they're strapped for cash. This is happening as we speak. So what a lot of banks have done is that they've changed the way they're locking loans, where they're not locking loans now until they're cleared to close, right? So how does that affect you? That affects you because the customer's not going to know what they really qualify for until the loan is cleared to close. And then we're going to have to lock the rate. So what if the rates went up and they don't qualify anymore? So again, this isn't a Cardinal plug. With Cardinal, we're not doing that. It's business as usual. And a lot of banks are business as usual, but a lot of banks have changed the lock policy. So it's important that you're aware of that, because if they change the lock policy and then your buyer you may get through the whole entire process and your buyer doesn't qualify anymore. Or for your seller, the buyer for that property doesn't qualify anymore. So it's really, really, really important. In 2008, the housing market was caused by homeowners defaulting on risky loans. To avoid that, the government put in an initiative for banks to create a forgiveness on payments for the next few months. The problem with that is mortgage services still have to make payments on those loans, in most cases, the government agencies, investors. So guys, just, like on an FHA loan, if a FHA customer doesn't pay their mortgage, the mortgage services still has to make that payment to FHA. So now everybody's not making payments. Okay, but FHA didn't say that the banks can stop making payments. So what's going to happen with that is that all these banks are making payments now that they're not collecting. Now, they're trying to address it right now, but it hasn't been addressed yet. So it's still something that needs to be watched by everybody. But federal regulators have recognized the issue and are working on a plan to change which was announced. So just to give everybody a heads up on that, those are kind of the two things that are going on with mortgage banks that could affect you guys, and it's important for everybody to know. Home funding solutions that are available now and how to get them. So kind of, this is guys, this is an update. This is some of the stuff from last week and some of the stuff we're adding this week. And the stuff that's new is highlighted. But just let me go through all of it again. So here's the good. FHA, Fannie Mae, and Freddie Mac agencies who provide 90% of financing is still open for business and fully functional. They are working to expand guidelines to assist during this time, and we'll get to some of that in the next couple of slides. Interest rates are going to stay low for the foreseeable future, with government stepping in and buying mortgage-backed securities. 3, municipalities are closed and cannot record, but we are still closing loans through our title companies who have taken out special insurances to allow this. We do not need COOs or municipal searches to call in the financial, and we don't need them to be able to record that deed to be able to close your loan, because title companies have taken gap insurance. So it's important to know that we can still close loans no matter what's going on right now. That's really, really important to let everybody know. We actually performed our first full video-only closing this week. So basically, nobody met. We closed over Zoom. We were actually able to close completely over that way through e-sign and over Zoom. So I think that's something you're going to see more of, and it's coming, but we actually performed our first closing this week that way, which is really, really important because it's going to let us continue to do business over the next couple of months. 4, on all conventional loans, we'll be able to close with a desktop appraisal. This means that the appraiser will not have to inspect the home physically. Also now, on FHA, VA, and USDA loans, a desktop or exterior-only appraisal will be allowed. So basically means on FHA appraisals now, we're allowed to do drive-by appraisals, right? So we don't have to actually inspect the inside of the property, even on FHA loans now, which is huge. The appraisals must include whether or not the appraiser did or did not personally inspect the property and the extent of the inspection. 203K loans, so renovation loans or cash out transaction refinance are excluded from this. So those are still not allowed without an interior inspection. So these are the good changes. These are the good things that are happening in the market and the things that I think will continue to expect the market on a go forward. The bad. Jumbo financing is no longer available for, I think, almost all lenders except maybe the big banks like Chase and Wells and Bank of America. This means loans must meet Fannie Mae, Freddie Mac, or FHA loan limits. So in most cases, you're not going to see loans above $1 million ever. On single-family residents, you're not going to see loans over $750, basically. So that's a big change in the market that, as of right now, there's no jumbo market. I think you'll see it come back, but for the foreseeable future, we don't have anything. 2, investor loan products that use rental income to qualify or fix and flip lenders have almost all closed their doors temporarily. But that may, permanently change, period. There are a couple of fix and flip lenders that are still active in the business, and they're still closing loans, but those investment rental cash out loans are pretty much non-existent at this point. So that's just something to kind of be aware of. Commercial financing guidelines have now been greatly restricted and may stay that way. And again, that's something to reach out for us all, but they definitely have changed commercial guidelines. 4, most lenders are not allowing loans to have their interest rates locked until a loan is cleared to close, which could cause affordability issues. Cardinal is still following the standard lock policy. So again, this is kind of back to what I said to you guys before, that it's important to watch. But we are still following the same policies. So, it's not the end of the world. So guys, that is pretty much the end of the presentation. I'll take questions from anybody that has them right now. Will that increase the number of homes that don't appraise? Mary asked. I don't think so. The drive-by appraisals, we haven't seen it affect anything over the last like 10 days that we've seen it going on. It's going to really depend on comparable properties, though. I think it actually helps you if a house is older inside, because as long as the comparable properties in the area are okay, then your desktop appraisal is going to be okay. But it's definitely something to look at because they're not going to be inspecting the inside of the house. So if a seller comes to you and they're like, "Look, I want to list my house and I have all these upgrades inside," this is a time unless they can get into the house, it may not matter. So it's just it's something to kind of look at. But yeah, again, I have people commenting that appraisals haven't been affected, and I don't think they have been. Thanks, Kelly. Appreciate it. Can we get a marketing email to send out to our? Yeah, absolutely. We can definitely get an email out to everybody. I'm going to get this presentation out to everybody and email out to everybody on what we're actually doing in the appraisal side. So we'll get that email out to everybody that's in this. Investor loans over $1 million, are they difficult now? They do go into commercial and multifamily units. As of right now, yes, they are difficult. I think you're going to see them go back to where they were before the last 3 years, where it was mostly on that stuff, more hard money lenders or specialty lenders doing those loans. They still are available, but they're requiring probably a 30 to 35% down payment at this point now, and points, and it's just a harder transaction than it was 2 weeks ago. Most of those lenders have come to us and said, we're freezing operations for 3 to 4 weeks. They haven't said we're going out of business. I think that's more like 8 to 10 weeks, but I think they'll be back. How much will home values drop? 10, 20%, your opinion, of course. Like I said at the beginning of the presentation, I don't think that you're going to see home prices drop a huge amount. In the worst market ever in 2008, we saw market values drop 30%, but that was a housing crisis. This isn't a housing crisis. It's a huge difference. You're going to see properties drop because people will be discounting prices, but I think it's more likely 10% than it is 30% if you see anything. I don't think you're going to see a significant, ridiculous drop in prices at this point. Does anybody else have any other questions? All right, guys, I thank you for this. We're going to try. Oh, here we go. Hard money lenders were doing 10% down and purchase 100% rehab, but they've tightened up. Will this come back? I don't think you'll see that come back. I think, yeah, thanks, Ed. I think that, that as I saw in subprime, because I lived through subprime, a lot of stuff that was going on before was because there was so much money in the securities that Wall Street was buying. And now that securitization market has dried up. When it comes back, it'll come back in a much more conservative manner. So I don't think you're going to see that 10% down come back. I think 20% is the new norm. Yes, Royce, I'm going to the email. Anybody that registered on the Eventbrite site is going to get an email with this presentation. You're all going to have it. You guys, so at this point, there's no lender for high-end purchases at home. Mary, the only one that I know of doing it right now is Chase and Wells Fargo is still operational for stuff that's over $1 million. They're it, though. They're really it. So you're going to see them flooded, and they're going to be backed up. There's really no other lenders out there really doing it. And the reason being for that is because there's no market for it on Wall Street, so nobody's buying the paper, and there's no securities market, so nobody wants to do that. And Citizens also, you're right, Chris, correct. Citizens, Wells Fargo, Chase, Bank of America. I think those are the banks that are still doing the jumbos, but that's really it. So any loans that go through Cardinal will not require CVO. We do not need a CO or municipal searches. We will see attorneys that still want them, but we do not ask for them. We never have before this or afterwards. So correct, yes, so we don't need that stuff. Guys, look, as far as the jumbo market goes and the hard money back in the investor market, the jumbo market will 100% come back in the next 3 months, I would say. You're going to see that come back because there was value in that market. I think why it has stopped is because people are afraid of large-scale long-term risk. So they don't want to take on a huge loan on their books and that they have to keep for a long time. Right now, when liquidity is tight and they have no money, they don't want to take on huge loans that they have to keep on their books. So that's why you're seeing that dry up, but I think that'll come back. Yeah, there's no more non-QM right now at all. Those banks have completely stopped lending. So, they all telling us 3 to 4 weeks. I think you'll see it come back, but maybe not the same way. Yeah, I'm definitely worried. I just watched the head of FHFA speak on CNBC as far as the long-term income of people being out of work. I think that we're going to see unemployment rates hit higher than we've ever seen before, and I think that's going to affect our business over the next 6 months to a year. I think they're going to have to make specific guidelines to that when this is all over because it's such a you're not going to be able to go off standard underwriting guidelines for employment gaps when everybody had an employment gap. So I think there'll be special lending towards that. But yeah, it's definitely. I think that's where you will see problems. There'll be people in the market that can't afford to buy right now because they were out of work. Correct, Chris. Yeah, there's a difference between furlough and being laid off. So some people are being laid off temporarily and some people have been fired. The people that being laid off temporarily, as long as they're back to work, all we need is a pay stub to qualify that. And that's going to be all mortgage banks. So that makes a big difference whether they were furloughed or unemployed. And you should really be cognizant of that. What cities do you recommend to keep the most updated, not news necessarily, but accurate business related for us? That's a really, really good question. I think that, unfortunately for a lot of us, we live in New York and New Jersey, and we're kind of the center point of this. So I think a lot of the stuff that's happening is going to happen here. As far as countries, China is a market with a big real estate market, and I think what we're seeing happen there is going to happen here next because they were affected like we were affected. So I think it's important to watch that. As far as cities here, I think, I don't think anybody's outstanding the rest of it. I think Manhattan was hit so hard that there'll be a good gauge for us to see what's going to happen with the rest of the market because it's being hit so hard. In your opinion, how will the non-QM market change after all this? I've done business with Vizio, and I know they're not funding at the moment. Darwin, I just think that you're going to see reduced loan to values. You're going to see higher down payments. You're going to see higher, from 2010 to 2015, all these investor loans existed. They still existed. People just didn't know about them as much. They just required a much larger down payment, and the interest rates were higher. They were 14% instead of 7%. They were 4 points instead of 2 points. They were like more of a down payment. So while I think that'll come back and people are like, well, that's going to affect us. It's definitely going to affect us. But what people were willing to pay that then and not now is because there were much bigger margins on flips because there was much more value in the market. So now there's less value, but your carrying cost is low. So I think what's going to happen is you'll see better rates of margin come back because there'll be less investors in the market, but you're going to pay more for that carrying cost of money. But there will be product. There 100% will be product. It just what does that product look like? And I think it's going to be reduced LTVs, higher down payments, higher interest rates. So if they were pre-qualified before and they're shopping and now they're out of work, they have to see. That's what they're not telling us. They do have to be back to work. That's what they're saying. All this relief, but that person has to be back to work. Furthermore, even though mortgage rates aren't reporting to the credit agencies, a customer for a mortgage bank is going to have to be current on their mortgage to do anything on anything. So if they're deferring their mortgage payments, they're going to have to get back to being current before they're going to be able to take financing again. So that's something to be aware of. As far as the jobs go, yes, they're going to have to be back to work before we're able to lend them money. So if you have somebody that was pre-qualified, it's important you get them pre-qualified again once this kind of ends, especially if they were out of work. Again, furlough is different from being unemployed. Self-employed is the same, Ed. It's not going to really change anything. That's the good news. If you're a self-employed person, you're a self-employed person. So where I do think it will affect people in 2021 when they're doing their tax returns and they have to explain why they had their income was declining, that's where they'll be affected. So if there's a declining income in 2021, I think that explanation that business slowed down because of what went on is going to be a good explanation, but that's the only time it's going to affect them. As far as right now goes, they will not be affected. Being self-employed will not affect you except for, declining income. No, I mean, so Zora, so basically what you're hearing is it's going to take a year. The reason you're hearing it's taking a year is because if you have a mortgage late, basically you won't qualify for 2 months. So this, we haven't gotten exact guidance on this yet, to be totally honest with you. Here's what I will tell you. We get our mortgage history for the most part from the credit reports. If the mortgage agencies are not reporting to the credit reports, which they've been instructed not to do, and that person is then caught up on their mortgage, I don't think you're going to have an issue because everything's going to show that they're up to date. Their payment's not going to be deferred. It's not going to be deferred interest. So, but I can't guarantee that. That may change in 3 months from now. But as of right now, it's not reporting to the credit agency. So as long as they're paid back up and we get a payoff statement on that mortgage saying that they're current, there's nothing to say that they weren't. Now, after this is all over, Fannie Mae, Freddie Mac, and FHA may come out with a guideline that says we want to see a mortgage history from the mortgage company to show if they were back or not. But that hasn't been communicated to anybody as of yet. Guys, these were awesome questions. I really appreciate everybody. I think we're done. If anybody has any other questions, just let me know. But if not, I'm going to wrap it up. But I really appreciate everybody for joining, and we're going to be back next Wednesday. I'm going to try to give you an update on what's going on. I thank you guys for all the stuff, and if you need anything in the meantime, my contact information is here. So whether you want to reach out to me or get connected to somebody else here, just let me know. Yeah, and everybody be safe out there, and hope everybody's healthy, and I'll talk to everybody soon.
Thank you.
Thanks, guys.